Ferrari's stock just took a massive hit, its worst single-day drop ever in both the US and Europe. On Thursday, shares of the luxury automaker plunged nearly 15% on the New York Stock Exchange, closing just above $407. In Milan, the story wasn't any better. Ferrari's stock fell more than 14%, losing about €60 to around €357 a share. During Ferrari's Capital Markets Day event, the company unveiled updated guidance that disappointed investors. Ferrari now expects revenue of €7.1 billion this year, slightly higher than previous forecasts, but it's the long-term outlook that rattled the market. The automaker projected about €9 billion in revenue by 2030 with adjusted earnings of at least €3.6 billion. That's below what analysts had hoped for and far slower than the growth Ferrari promised just a few years ago. RBC Capital analyst Tom Narayan said Ferrari's new numbers looked conservative and investors saw that as a major downshift. CFRA even downgraded Ferrari's stock to a sell, cutting its price target from $475 to $350, warning of slowing growth ahead. But not everyone's bearish. Some analysts, including JP Morgan and Deutsche Bank, still have faith in Ferrari's long-term plans. JP Morgan wrote that demand for Ferrari cars continues to far exceed supply, and Deutsche Bank even upgraded the stock to a buy, raising its target to €520. And there's another twist: Ferrari is easing up on its electric vehicle ambitions. The company now plans for its future lineup to be 40% gas engines, 40% hybrids, and just 20% fully electric cars. That's a big change from earlier plans that aimed for 40% EV sales. The shift came as Ferrari introduced its first ever electric car, the Elettrica, expected to hit the roads in late 2026. So while Ferrari's stock may be slipping now, the brand's long-term race is far from over. The question is whether investors believe it can still stay in the fast lane.